Welcome back to the penultimate session of our course Research on Corporate Transparency. Today we're going to talk about tax transparency, and for this we have Martin Jakob from the WHU Otto Beisheim School of Management with us. So Martin is also a fellow member of the TRR 266 Accounting for Transparency and has worked extensively on all questions related to corporate taxation, ranging from issues such as investment effects of taxation, effects of taxation on payout policies, and the role of tax avoidance and income shifting. More recently, he has also looked into issues related to tax transparency and the effects of tax transparency widely defined. So this is why we're very much looking forward to his talk and the subsequent discussion. Martin, over to you.
Thank you, Joachim. Thanks for having me, for inviting me. It's great to see 80 people being interested in tax transparency. This is really great. Many thanks for organizing this entire course. I know from at least my PhD students that they really like it so far. I'm not sure about today's session, but at least next 2 weeks then it will be better. So what I'll talk about today is I'll try to talk very broadly a little bit about tax transparency. I mean, you have seen the 3 videos by Joachim. I've seen them as well. And of course, we can talk endlessly about this. So what I first of all do is I will only focus today on corporate tax. Yeah. So Joachim also, one of his examples in the 3rd video, talked about personal taxes and how in the US, who pays taxes. Let's forget about that for a second. Otherwise, we enter in a whole different debate. I'm not saying that this is not an interesting debate, but it's a different debate. Yeah, it is a super important debate, but that's not the topic for today. Today, let's talk about corporate tax transparency. And one thing that I want to start with, maybe a bit broader, a bit of background, is so-called corporate tax avoidance. I mean, I think we all have this picture in our mind that some companies manage to basically shift their profits to a nice island somewhere with nice beaches, sunny weather, yeah, where we would love to be. Yeah? And this corporate tax avoidance, I mean, it is, of course, a concern to policymakers. It's a concern to the public and to many people, many stakeholders. And what we see in the last years, there are multiple approaches to tackle this issue. Yeah? You have the OECD Base Erosion and Profit Shifting Initiative. It's a cross-country effort, very successful. And you see that even without this BEPS initiative, this Base Erosion Profit Shifting Initiative, there's a trend towards more and more rules that actually fight tax avoidance. Yeah, and one element now of these, and this is where it becomes relevant for what we do today, is you have this element of more tax-related disclosures and reporting. And let's put this broadly, tax transparency. Yeah, Joachim nicely explained, you have this private and public tax disclosure, and the OECD BEPS initiative has like both components somewhat. Yeah, and in addition to that, you also see more coordinated tax enforcement efforts. Why do we care about this? Well, first of all, we already know that the rules that are now out there, well, they generally actually reduce profit shifting. So we have evidence for that, that in that sense, they are actually successful. How successful they are? Well, of course, profit shifting is still out there. So one step that is seen as the next natural step is tax transparency. And one of that is a so-called country-by-country report. I don't think that everybody really knows what a country-by-country report is. Just in very simple words, it would be Jochen has his firm, and Jochen publishes a report now where he says, okay, I operate in Germany, in France, in Italy, and in Ireland. This is the number of employees I have there, number of sales, number of assets, and so on and so forth. Yeah, that's a country-by-country report. Yeah. Now, what I then also always think is, let's take a step back and what do we actually want to achieve with transparency? What is the objective here? And if I think of the government, well, you could say maybe maximize revenues, maybe ensure a fair and equitable tax system, maybe incentivize investment and growth. Of course, you may not be able to achieve everything at the same time, right? And if I think of firms, well, what they always say is they pay the tax that they owe. Or let's put it in different words, let's comply with the law. But that means you can actually avoid taxes, but in legal ways. It always reminds me of Apple when they defended their tax strategy by simply saying, well, we always stick to the law. We didn't do anything wrong when it comes to the law. Of course, law and what we perceive as fairness might be 2 different things. Another thing that firms really care about is to avoid double taxation. Yeah, Jochen, when he operates in Italy, what he does not want is that he's taxed twice in Italy and in Germany. For that, we have treaties, yeah, but not with every country we have treaties. And of course, ultimately, in the end, we will consider the after-tax profits as a firm. Now, the problem is that there might be a potential trade-off between these two things. And Joachim already mentioned one paper by Marcel Olbert and Lisa de Simon. And this is an interesting paper because it shows that country by country reporting actually leads to more investments in low tax countries. So what they try to do here is not, oh, transparency comes, I now avoid less taxes. No, transparency comes and I actually shift my assets and my activities to low tax countries to substantiate what's going on there. So it might actually have the opposite effect of what countries want to achieve. Now, what we also know is that there are two sets of disclosures in the US. FIN 48 is a public disclosure, Schedule UTP is a private disclosure. And we also know that these reduce investment or delay large investment. So there can be adverse investment effects. So whenever we now, and this is what I want to do now and want to base my discussion on, is what are the costs and benefits actually of tax transparency? Well, the benefits, you could say, there's less tax avoidance. And this is apparently an issue. Well, it's questioned a little bit by current research. Then, of course, two other benefits could be that I can actually identify. I mean, I personally know that Jochen is a good citizen. I know that he would never do anything bad. But I would ideally like that everybody can look at the numbers, at the disclosures, and recognizes Jochen to be a good citizen. Yeah. And when then they come to me, they might think differently. Yeah. So it's this identification, who's actually a tax avoider, and then maybe you could put pressure on firms. Now, on the other hand, you could also have costs. One type of cost of tax transparency I already showed you, real responses. Firms might just invest less or delay large investments, or another one is a proprietary cost. I may actually do not want that all the other companies can see where I operate. Yeah, I mean, that's my business secret, you could say. Yeah, why should I reveal all of that? Yeah, that's, for example, the case in terms of a country by country reporting. So in the end, we have to weigh these costs and these benefits. Why do I say this? Well, there are some efforts. Australia is one example. Joachim, I think you mentioned this already in the videos, where you have actually public tax disclosures by the tax authority. And what happens there? The Australian tax authority publishes more than 2,000 firms, the names, sales, taxes paid, and profits. So basically what we can do now, what I did for you here, is to calculate the effective tax rate of each and every single firm in Australia. And this is the distribution then. You have some firms here, which I would call bad citizens. They don't pay taxes. Then you have some okay citizens that pay something between 0 and 30. 30 is the tax rate. And then you have the good citizens. Yeah. Of course, I label them that way. Now, what could be the reason to everyone here? What could be the reason that you don't pay any tax? What could be the easiest reason why you don't pay a tax? Yeah, what could be the reason that you don't pay a tax?
You are allowed to answer, by the way. So let me chime in.
I mean, I will ask questions, so please answer.
Yeah. So you can just unmute yourself and say.
Or you unmute yourself, type it in the chat, whatever. What could be the reason for that?
Maybe
no taxable income.
No taxable income. Oh, surprise, surprise. And if you do that, oh, there are not many left. Yeah, so one thing that happened here, you were put on that list. Qantas is a good example. They put them on the list. And then, sorry for the word now, I know it's recorded, but still I have to say it. There was a Twitter shitstorm. Don't book with Qantas. Don't book with Qantas. They don't pay taxes. They don't pay taxes. So what happened? The CEO, who has actually other things to do, had to stand in front of the press and explain he didn't pay taxes because they didn't make a profit. Yeah. So it's like you then have to explain there is this public shaming going on, basically, you could say. Now, another thing about the problem of these disclosures, and that was actually one reason why we started the paper, was even if you pay 30%, that doesn't mean that you're a good citizen. Let me give you one specific example. Apple is among the firms that pays 30%. And if I would have asked you before whether you think that Apple is a good citizen and does not avoid taxes, the answer may have been different. If you just look at the 30% in Australia, the answer might be a different one. What is the point here? Well, Apple reports a profit margin of 5% in Australia, whereas their global profit margin is over 50%. Or to say it simply, Apple might be perfectly fine with paying 30% on whatever was left in Australia because they shifted already the other stuff out. Yeah. On the other hand, paying less than 30% doesn't mean that you're a bad citizen. How can that be? Well, for example, Australia has specifically R&D tax credits. So Australia sets an incentive that firms are innovative and utilize R&D tax credits, and then they put them on the list and say they didn't pay their 30%. Well, that's also a little bit the problem with transparency. And this is what motivated in our paper was to say, hey, what happens if there's public tax disclosure? Can now individuals, retail investors, filter out whether firms avoid taxes or not, whether this is aggressive tax avoidance or not, right? That was one motivating question for the paper that Joachim sent to you. Now, of course, what's the problem here is this, and what we now try to do with our paper is, can we identify tax avoiders? Yeah, because this is a potential benefit, right, of this tax transparency. And now, before we get to the paper, again, I need to ask you some questions. And I will now show you 3 different companies, 3 different settings. And what I would like to ask you is whether you think that this is aggressive tax avoidance, yes, no. So if you either use the chat for yes, no, or whatever, or just speak up. So this is, for example, a company that is headquartered in Germany. And let's say legally, they could now send their profits to a holding corporation where they just have that patent. And then just while royalty payments, they shift all the profits up here. By the way, of course, it's not that easy, and it's not what German companies can easily do. But just suppose for a second, German firms could do that. Would you regard this as aggressive tax avoidance, and would you regard this as unfair if they do that? Just it's your personal reception that can't be wrong. Any thoughts? Is that good or bad? What's going on here? Joachim, what would you say? Is that aggressive tax avoidance what they do here?
So I tend to say yes.
Because
I think whenever a firm has something located in a tax haven, I start to think about this as being tax avoidance.
Okay. Randomly, I don't want to randomly just pick someone, not sure. Anyone who wants to say it's, Ulrich writes that the only reason of the corporate structure is tax avoidance, it seems bad. So on paper, this seems bad, Ulrich, right? You would say, come on, guys, this is aggressive, right?
Yes, that's what I would say. I'll buy it.
I think if we would ask 100 people, most of them would agree with you. Yeah. Now let's do the next one. Now I see Joachim, they have the nice HU in the background. Let's do the following situation. I want to set up a new business. I now move to Berlin, and I really want to set up a new business. And I can pick 2 cities. I can go to Ludwigsfelde, where I did my A-levels. Yeah. And I could say, south of Berlin, it's nice there. Oh, tax rate is 28.3%. Or all else equal, I move a little bit to the east to Zossen, where the tax rate is 22%. And I picked Zossen. Is that aggressive tax avoidance? Ulrich, what would you say now? Is that aggressive tax avoidance that I go to Zossen instead of Ludwigsfelde?
Well, it seems to me that the difference, the 6 percentage point difference are not that large compared to like paying 0, if you move to like a tax haven, like, I don't know, the Cayman Islands, presumably. Right.
Okay, so for you, Ulrich, that would be okay. So if I do that, I'm okay.
Well, I guess so. I think there's an idea of having some sort of tax competition so that the governments don't get lazy.
Yeah. Joachim, what would you say? You were on the front of that other one was aggressive. What about this one? Ludwigsfelde or Zossen? Is that aggressive tax avoidance for you?
So here, if you ask me, then that really depends on, let's say, the utility function and whether the firm makes a decision to shortchange, let's say, the public stakeholder over some private benefit here. And then there's something that might be okay for the firm, saying, okay, this is a little bit better for our investors than for, let's say, the government. And then if this sort of utility function is rather extreme, then this is where tax avoidance begins. But I completely get your point. This is
good. Okay. Joachim knows the trick that I'm doing here. By the way, I see in the chat that Sebastian, when you write, if it's just about the mailbox, no, it's really like putting all my employees over there, right? And my machines really going there, with all the efforts, my real activity. So here we see already the blurry line between what is regarded as tax avoidance and where we could say that's actually maybe not aggressive tax avoidance, right?
One question there. So, but if you have all of your, say Ludwigsfelde has a great rail connection, highway, whatever, they may be able to afford to charge more in terms of taxes, given the great location benefits. So if you're actually locating your business there, then you're paying into the local community. That seems more justifiable than a free riding situation in which you shift your profits but benefit from other individuals paying taxes into common purposes.
Yeah, absolutely. That's a very fair point. That's why what is important here for this assessment is that I would say it's really about shifting the real activities and not just paper, right? It's really like where you set up your business. You don't even have anything anywhere else. And then but I can see this is where the tax stuff becomes tricky. Yeah. Now, what I'm saying here, the reason why I use this example is because some people would regard just the actual activity shift, really all my production facility over to the low tax jurisdiction within Germany as tax avoidance. And then again, here, it's not that we all have to agree on what we think it is, but I'm just saying that out there is this perception. And now we can make this even more extreme and say, what about your decision to set up your new production facility in Germany versus Ireland? And you go really with everyone. Yeah, I take Jochen, my manager, send him to Ireland. I give him a nice office in Dublin. He goes with 100 employees to Ireland. Is this tax avoidance? So you see, I mean, you can all think about this for yourself, but what you see now is it's not entirely clear what tax avoidance is. If you ask some tax authorities, they will tell you that shifting your real activities to another country is already tax avoidance. If you would ask me, I might answer differently. Yeah? But here you see the difference between paper shifting and what else? It's not entirely clear. So ultimately, one baseline that we always need for tax transparency when we give information out there, we always also need to think about the question, what do actually people think is tax avoidance? By the way, I'm sorry for the numbers. This is what happens when you talk about tax. Okay, so now let's come to the paper. What we now want to do in this paper is the question, how does public tax disclosure influence investors' perception about whether firms are paying their fair share? Now, we are agnostic about whether individual thinks that, oh, you should always avoid tax or not. We are agnostic about it, right? We do a random assignment here. So why do we do this? Remember, again, it's about costs and benefits of transparency rules. So now, how do we think about this in theory? Well, if I want to assess, or someone wants to assess whether someone pays the fair share, well, there's so much information out there. You have to think about what's going on in the industry. Is this less or more aggressive what they do? What about the contributions to society, corporate taxes paid? Those are a lot of things. Now, what we say is with public tax disclosure, as in Australia, what happens now, you go away from this examining everything and you just focus on what is paid. Yeah. And this is basically what we do here. We apply attribution substitution theory. There is a relatively inaccessible target attribute. This is like really going through this cloud here, and that's tough. And what you do is you substitute it with something relatively easily accessible. That's a heuristic attribute. Yeah? And what is important is that you're not doing this consciously. Yeah? Okay. How do we set this up? I mean, I'm not an experimental expert. This is why I have 3 great co-authors doing gazillion of experiments. And what we basically did was we then said, let's do a 2x2 experiment. What do we do is we, on the one hand, and this is basically also our hypothesis, we have a fair share perception. We think that, let's say, R&D tax credits are perceived as less aggressive than, let's say, really profit shifting on paper. What we're now saying that because of attribution substitution, the tendency to differentiate between these two goes down. Yeah, so basically more information actually doesn't help individuals to find out who's the good and who's the bad guy. Yeah, we can talk about this more afterwards, right? Of course, we do a classical 2x2 experiment. Yeah, for Joachim, no diff and diff. Yeah, no fixed effects necessary, nothing here, random assignment. We can control everything nicely in the lab. What we basically do, again, 2 dimensions, tax avoidance method. Either you use a tax credit or you shift profits on paper somewhere, and the second dimension is public tax disclosure, yes, no. Yeah. Now, what we also did, we also asked in general our participants how they perceive whether R&D tax credit or profit shifting, whether this is fair or not. And what you see here on the right-hand side is, on average, they think that using the R&D tax credit is okay. Yeah, is still you pay your fair share, but if you shift profits, then it becomes dodgy. Yeah, and it's perceived as less fair. Now, what happens basically is when we ask the people, hey, do you think that this company that we use is paying its fair share? Without public tax disclosures, they can actually distinguish these two guys. But once public tax disclosure is in place, you cannot distinguish between the good and the bad firm anymore, to put it in very simple words. Yeah. Why is that important? Well, it trickles down to investment perception. What does that mean? As it trickles down to the question whether I will invest in that firm. So it could have theoretically real implications. Why can that be? Remember, it was attribution substitution theory that we said is going on. And what we see here is that in the no public tax disclosure, they significantly spend more time looking at financial statements. Yeah, so they indeed use more information when they have no public disclosures. Yeah. We also replicated that when you have really low effective tax rates. So we did an extreme case. And then we also asked whether country by country reporting helps. So whether really disclosing multiple countries helps. And it doesn't. It doesn't enable firms, it doesn't enable participants in our experiment to now distinguish between tax credits and profit shifting firms. By the way, the fact that there is no difference here makes sense because attribution substitution theory tells us that the attribute, the heuristic attribute must be easily accessible, and it's not with country by country reporting anymore. Yeah. Okay, now one question that came up during the in the set of questions is, okay, we do this for retail investors here, and maybe this is not the right group of people. Yes, indeed, it might be. It's a potential issue of the study, but I personally believe, and this is now based on an anecdote, not on scientific research so far, but that would be the next step, of course, is it that others are doing a much better job. And what you have here is the voluntary public tax disclosure by Vodafone. They voluntarily issued their country by country report, and they were praised by NGOs for being so transparent. Now let's look into the numbers of Luxembourg of that report. What you see here, in the year 2018, they had revenues of 133 million. They had profits before tax of roughly 1.5 billion. Joachim, how many firms do you know that have a profit margin of 1,000%?
Not that many.
Not that many. But the good news for Vodafone is on these 1.5 billion, they paid 9 million taxes, out of which 4 million are corporate tax. The statutory tax rate in Luxembourg is 35%. So NGOs who praised Vodafone for publishing a country-by-country report, finally they're transparent, did not use that information, apparently. Yeah. So this makes me actually think that, hey, maybe public tax disclosure may cause retail investors to over-rely on imperfect information. And it could actually be that some type of public tax disclosure might actually have opposite effects of what you intend initially. And it could be. Now I'm putting a lot of caveats now on the statement. It might actually be that firm level tax disclosures may do more harm than they do good. Yeah, for the reasons I outlined before, the costs. Now, of course, now a final question for some thought. Who actually should be more transparent? We only talk about companies being more transparent, right? But what about countries being more transparent? Why do I say this? Well, we have some colleagues here from the Netherlands, my dear co-authors, for example, and some others. I think the Netherlands and some other countries are known for signing tax rulings with companies. How many do we know of them? None. Why don't we force also transparency from the tax authority side? Why is it only that the taxpayers have to be transparent, right? So one thing, of course, or could it be that both have to be transparent? And by the way, I find this is maybe an unfair game because, of course, countries can force firms to be more transparent without being more transparent on their own. So we have a lot of transparency related angles to talk about. Thanks for the attention and sorry for taking more of your time. And now, Joachim, I'm happy to answer whatever question comes up.
Thank you. That was excellent and very entertaining. Am I allowed to say that something is entertaining when it's supposed to be academic? Yes, I am, I think. Okay, so as indicated, I think you can now stop share your screen and we will gonna start taking some questions. And you know the basic rules of the game. If you are speaking up, you are free to introduce yourself to the audience and everything will be videoed. So yeah, you know that you might end up on YouTube. So we're gonna start with Ariana. Ariana, please, over to you.
Hi everyone, and thanks for the nice presentation. Also, I really enjoyed the live questions. So I'm doing the PhD in Lausanne, at the University of Lausanne. And I have two questions about the experimental design, because I was curious to know first about the choice of the company, the telecom company. I wondered, why did you choose exactly that industry? Because I thought, why not a fictitious company name that maybe could be more anonymous? If you thought about, for example, some previous knowledge that the respondents could have about the industry, or even there is even an Italian company that is called Telecom that maybe, I don't know. I wonder if this could bias the results, or maybe in your experiment or in general. And the second one is, how did you ensure the consequential behavior of participants? I studied this year in an experiment course that we should worry about the real choice, if the participants actually are involved and motivated in the experiment, and how do you address this to ensure that they actually then in the real life would invest in the company?
Both are fantastic questions, I can say. Let's start with the first one. That's the easier one. Again, for us, we thought long about this. We had a lot of pre-trials. We quickly fixed this to, let's say, a more innocent company and sector. Why did we do this? First of all, we wanted to control the experiment as best as possible. If we just give a random name, Alpha Corporation or whatever, yeah, then people might have Apple, Google, and whatever in their mind. So we wanted to shift them to a certain industry, to a certain type of firm. And then, of course, what we did is then within that, we randomly assigned participants. Yeah, they all got the same company. So at least within the experiment, we don't see any reason to believe that this would affect the difference between public versus non-public tax disclosure. Yeah, of course, people might perceive the telecommunication sector as way more tax aggressive than others, but what we then wanted to exploit is the perceptions within that setting. And then we wanted to introduce the public tax disclosure treatment, and of course also the income shifter versus tax credit shift. Income shifter versus tax credit ETR reduction method. Yeah, but it's a fair point, but this was basically to keep control. The other one is, I think, a really, really, really good question, and it's a tricky one. And here, to be honest, I can just say I fully relied on my co-authors and their experience. So for us, the perception, the fairness perception was the key question. We also asked them about the investor perception. So for us, the real decision in terms of investing was not the most important thing in our design. And that's why we chose that type of experiment. In the old experiment, in my first ever experiment that I did with Jochen and Kai Blaufus and Matthias, the old PhD student from Jochen, we did exactly a real effort experiment, because there it was about the labor supply. Yeah, so for us, the choice was based on what we are interested in. And that was the reason why we chose this type of design, being fully aware of this difference between, do we have an incentive or do we not have an incentive? I hope that this answers your question.
Yes, thank you. Thanks a lot.
Can I quickly answer Jeremiah's question? Because it's a real good one.
Sure, yeah.
Jeremiah, of course, I made it a little bit simple in my presentation, right? To just say that, okay, reduce disclosure just because they are immature. Of course, the problem is, if this potential issue of not getting the information right creates externalities and creates costs for firms, then it becomes tricky. If you have to hire hundreds of, I mean, I'm exaggerating, of course, but yeah, if you hire hundreds of PR people just to get rid of all these questions, then of course it's costly for firms. Yeah. If there's misinformation out there, I'm not saying that, okay, you should reduce disclosure because people don't get it, but of course you should ask for disclosures that can actually help identifying what you want to identify. And what I'm just saying is that the disclosure in Australia is an example for, you want to find out who's avoiding taxes? That disclosure doesn't help you. Yeah? It's information out there that creates costs, but it doesn't help you in isolating who's actually a tax avoider, because you don't know why a firm paid that tax rate. Yeah? And that's, I think, the problem of exactly that disclosure type that some countries have. Yeah, that's the reason there. I'm not against reduced disclosure or for it. It's really about what is disclosed, and this information can be used properly to achieve the goals.
maybe to chime in here, because this is something that we also discussed at other places throughout the course. So I think this is a really, really important area of transparency work more general, that you have to think about transparency in the eyes of the receiver. So there is this mismatch between what the sender emits in terms of signals and what is actually being understood by the receiver. And I think this has often been overlooked by prior literature. There's often been assumed that whatever a firm discloses will also be understood by investors or taxpayers or whoever is the receiver. And I think this directly relates to the session we had with Beth Blankespoor about these different components of information processing costs. And so this is why I use this term tax literacy in the videos. This is a little bit of a awkward term to use, but I think if you think about making taxes more transparent, one angle to think about this is really to think about educating people to become more tax aware and to understand these differences better. And I think this is an interesting angle to this whole argument. But I also completely see Jeremiah's point about using this as an argument to reduce disclosure, in a very simple way, would of course be also a little bit awkward.
No, of course, that was, as I said, it was a little bit made too simple, but it's really, I think, what I'm missing a little bit in that, at least the public policy debate, is a cost-benefit trade-off. That also this information might be misinterpreted and that it creates potential externalities.
Yeah, I absolutely agree.
And I think that's, by the way, I love the tax literacy aspect, and I can only advocate for having tax classes as mandatory classes in every curriculum. But of course, any non-accountant who runs a bachelor program might disagree with that. But of course, I mean, tax literacy is important. And if you think of education, there are many, many people out there who run their own businesses who have never, ever thought about any tax-related issue. You just think of doctors, lawyers, and so on. I mean, there are many people running their own business, but they never took a BWL class or a business class or a tax class, and it can be a problem.
I agree. So we have another question by Rusha, and this is a question related to the experience level of the participants. Rusha, over to you.
Thank you. Thank you, Martin, for the presentation. So I'm Rusha, and I'm a PhD in accounting student at NHH Norway. So my first question to you is regarding the experiment design. So in the study, you described that you select your sample participants after certain screening tests that you have mentioned in your sample selection. So I wanted to know, how do you taste for the tax knowledge that your participants have? How do you control for the differences in the level of tax expertise among the participants? Because some of the less sophisticated investors or participants may have a lower possibility of looking at tax reconciliations when they have other designated disclosures, because they may not be comfortable with assessing the tax reconciliation. So how do you control for that?
Yeah. And I mean, that's a very good point again. And this is again where we always, I mean, again, I'm not the experimentalist, so that's why your question is very, very well taken, because I have similar questions when thinking about this, right? And then comes the design in place where we say, we're actually agnostic a little bit about what is the actual level of tax literacy. Why? Because we randomly take our 500 plus people and just randomly put them into buckets. So on average, this is actually similar. And what we can show is that, I mean, we have also then at some point in the graphs that I showed you, we also put some regressions behind it where we control for that. And consistent with randomization, it doesn't change anything. Yeah. So one beauty of experiments is that you can create that high internal validity that you can actually ignore that potential comment. Yeah. And in terms of, okay, I know that now us 82 here, we are super tax literate. Of course, we would score high maybe, and others would score low. But as soon as we randomly put them into the experiment groups, into the treatment groups, on average, it should not affect our result. Of course, the level of tax literacy differs. And what we do is we screen, and it's important, we don't screen on tax literacy, we screen on financial literacy consistent with prior literature. Yeah? So it's not that we require a certain level of tax literacy in the paper. I don't know, Victor and Christian are also here. I don't think we ever screen specifically on tax literacy, right? Maybe Christian and Victor can put that in the chat. I don't remember any test where we did that. Yeah. But it's a good point. Maybe we'll think about that.
actually, I'm very new to tax research as well. So it's just a thought that came across on my mind. But thanks, I got that point.
Yeah. But one thing, of course, that could be interesting is whether people, I mean, what we did not yet exploit is whether people with high versus low tax literacy, whether they answer differently. That we haven't checked yet.
So just because also Victor asked in the chat, so whether tax literacy is a subset of financial literacy. So first of all, I Googled the term before putting it into my slides, but there's very little on tax literacy as a term. And there's clearly no established instrument that you could use for tax literacy. So what I had in mind, I think, is different from financial literacy, because financial literacy to me is very close to math skills, compounding, these kind of questions, at least the standard instruments that I know. And whereas when I think about tax literacy, it's more about these questions like, I'm not paying taxes when I make a loss. These fundamental questions that are more institutional in nature. Yeah. So the difference between, let's say, a tax rate and an actual tax payment in a progression, these things would be in my mind, maybe, the difference between tax bases. So stuff like this. But really, really interesting discussion. So now we have questions. I think there's a set of 3 related questions by Kefi. Kefi, please, you go.
Hi, everyone. I'm a master's degree student from Humboldt University, majoring in the economics and management science. First of all, thank you for the lecture. It's very interesting. And I have some, actually 2 questions regarding the experiment. First of all, I have some question regarding the order of the rating fairness perceptions and the investment related questions, like how the way they were presented. I would like to know, like, is that possible that the participants will adjust their actual investment intention in order to be consistent with their previous answer that's shown in the questionnaire before? And then also, since all the information was given to them was quite limited to the financial statements and then the public disclosure information, or even without them. So for the participants, especially for those who were offered with the public disclosure, like maybe they would have an opinion, or they would have a sense of feeling like what they are supposed or what they are expected to do during the experiment, and this might influence the results. And the second question about the experiment is that I actually checked the appendix of this experiment, and then I noticed that the word that used in the background information, such as a mismatch, I'm not sure, but I think, well, it may kind of imply the participants that the profit shifting does not accordance with the tax fairness, and then gonna influence their choices later on.
Yeah, those are all 3 excellent questions. The order is indeed, I don't want to rule out that the investor perception question might be somewhat affected by the answer that you gave before, right? So that you answer in concordance. Of course, what you could do is you could randomize the order of these questions, and you would just need like double the participants, which is not always easy to get. And remember, again, our main question was the fairness perception. Yeah, and that's why we focused on this order. But you are absolutely right, Kathy. If it would be about both questions, or let's say this, if it would be about only, let's say, the investment perception and the investment decision, then we would have set up the entire experiment in a different way. You're absolutely right. Yeah, I cannot say anything else. Now, when it comes to this, the idea that in the public tax disclosure setting, they did what they were expected and supposed to do. Given the way we had the instructions, and given that they didn't know that there were 3 other treatments, I don't think that this really happened. Yeah, you see, like say, I put Jochen in one, I put Joachim in the other one, and they didn't know how the instructions of the others looked like. They didn't know what they see. Yeah, and we also ensured that no participant ran the experiment twice. Yeah, so that it's not that they, oh, this time they asked me this, okay, then I know what's going on here. So I doubt that these guys really knew what we were after. Yeah, I mean, I cannot fully rule it out, but I don't think that because they weren't aware of the other treatments, that this was an issue. Yeah? And again, it was random assignment. So the word mismatch, when I saw that in the questions, I mean, I don't want to rule out that because we used the word mismatch that this happened. We used many pre-trials that never showed up. Yeah. Now you come, and I don't want to deny what you were saying, but I would at least, in defense of what we find, say that it should not affect the difference between public versus non-public tax disclosure, right? Because it affects both treatments at the same time. So you're right, the word mismatch might drive down the overall perception that this shifting is not fair, but it cannot explain why it changes for public tax disclosure. Yeah? And I think what you mentioned here is a very fair point, but I don't think it would explain the difference between the non-public versus the public tax disclosure.
Okay, thank you for the explanation. Yeah, that explains a lot.
Good.
Perfect. Now, Rusha, you have your second round with a question related to whether the results could also be explained by limited investor attention. Well, Rusha, over to you.
And my second question on your paper is that one of the findings is that when there are designated tax disclosures for retail investors, they become worse, or they're less able to identify firms with more tax aggressiveness. Does this result provide support to the evidence of limited investor attention theory, whereby more designated disclosures are, so to say, drawing attention from the tax reconciliations of investors? Does it provide support to that theory?
I mean, I think here is really the question, what do you think is the underlying theory with a limited attention story? I mean, why would you then go for the other attribute, right? So basically the way we see it is that you go from the whole set of information to the easier accessible corporate tax paid. And the way that shift for us fits more with the attribute substitution theory than with the limited attention theory.
Okay.
Right? Because you shift to a different set of information that is easier accessible, and that's why you do it. Yeah. And so that's why I can see your point. Probably the limited attention is somewhere in that whole process. Yeah. But ultimately, I mean, we then rely on this attribute substitution theory to explain why this is going on.
Okay. Okay. Yeah.
I can see your point.
Yeah. Okay. That explains. Yeah. Thank you.
I also thought about this, whether this is just some rational behavior thing, but based on what you do and what you find, I think I'm relatively convinced, I have to say, that this is just the switch of focus to the ever heuristic. I think it's a richer theory to some extent, Rusha, right? So it's a better theory to predict. It gives a finer prediction than just limited attention.
And it's really rational, right? Joachim, I mean, this is the thing, right? We don't have to assume irrationality here. Yeah. It's rational that this happens.
Yeah. No, I like that. So now we have a question by David, and I think this question, I have to praise myself for a second, because I just noticed that this question is actually nicely opening the door to the more general questions, but it's still related to the paper. So David.
Yes. First of all, thank you for a great presentation. It was really insightful. So I have another question related to the paper. So the results in the paper made me really curious about how retail investors use tax disclosure in general. And this might be slightly outside the scope of the paper, but I wonder if you have any anecdotal evidence on how tax disclosure affects retail investors' investment decisions in general. So I wonder whether retail investors use tax disclosures firsthand, and whether this relationship you find in the paper between fairness perceptions and willingness to invest can be generalized, or if you have any examples of places where you can see this in reality.
Yeah, so this is a super important question, and the good thing is, David, I am somewhat prepared for that question, because it's not the first time that we hear that question on a paper like this.
Okay.
So the question that you ask is a super relevant one, right? I mean, in our study, we assume retail investors. Now, of course, you can rightly argue, as you do, and says, hey, do retail investors actually use tax disclosures? I think, first of all, we need more research on that. That's for sure. The second thing why I believe that retail investors use at least somehow disclosures. I mean, in the end, also retail investors make investment decisions in which companies they invest. So they might read analyst reports. They might look at profit and loss statements of firms. And in these profit and loss statements, somehow at least some tax information is in there, whether it's specifically the effective tax rate or tax expense. So if you make a conscious investment decision and you buy a stock with looking at a financial statement, especially when you look at the after-tax profit, you will stumble upon the ETR. How often they use that and to what extent they consume this information, I think we would have to find out. But at least I would say that also intermediaries and analysts use this information, David, right? And then the investor might read the analyst report or something on taxes. Yeah, so it might be indirect, it might be direct, but I would at least say that retail investors are not completely ignorant of tax. At least I hope so, because it's my job to teach tax. So, yeah, but I can see your point that one assumption here is that they actually use tax disclosures. We don't show that in the paper, but I think showing this on a larger scale, how often actually they use that would be interesting. Yeah, that's definitely a good point.
Yeah, maybe also chiming in on this. So sorry, David, you wanted to say something?
No, go ahead.
No. Chiming in on this, I also when I thought about the study, I really liked the general idea of the study. I was also a little bit challenged, let's say, by this investment angle. First and foremost, because I also have my reservations about whether these how likely are you to invest kind of questions really add that much. But I see that this is very common in the literature that people do this. But even more so because I think it's not necessarily an investor that I have in mind here. I think the topic that you're looking into I think it's much broader, right? So whoever is a stakeholder of such a firm and has an interest in assessing the fairness of the tax payments of this firm is potentially subject to this, to these heuristics that you document. And I find this to be relatively likely, so that people will jump to the easier heuristic whenever things are complicated. And then, I really like this. So, but I also like David's point a lot, because I think we need more first-hand evidence on the information that people actually use.
Yeah.
I think throughout financial accounting, we make all these assumptions, and in tax as well when it comes to disclosure. So, Martin, do you agree?
I mean, I can fully see your point, and of course we could make it motivation a bit much broader. You say employees, absolutely. Yeah. Employees will definitely be interested. Customers might be interested. In the end, ultimately now I'm making a very big step. Voters.
Yeah.
Right? When you think of policy, you want to understand how a certain policy changes something, right? Then you vote for a certain party. So I think that the group of retail investors can be relevant in a lot of instances. David's point and your point, Joachim, how they really use actual disclosures might be interesting, but that may be even more so that these heuristics are then used when information is disclosed. Yeah, that you actually, because the target is so far away that they can only use the heuristic. Yeah. Not sure, maybe that's,
it's a little bit akin to this discussion on narratives, yeah, so that the econ people had on the Schiller note, right? So economic narratives, if you think about what sticks when it comes to disclosures, most likely not the complex tables with all these little data items, but the big takeaway, the story around this. And it's really interesting to think about it. So now we're moving on to somewhat more general questions. So no crazy questions about experimental designs or whatever anymore. Although not that the questions were crazy, they were actually really good. But now moving on to the more general topics. And there we have a bunch of questions that Caro sent in. So Caro, I hope you're around and can unmute yourself and start asking some of your good questions. Now Caro is not around. That's too bad. So let me
call that tax avoidance, by the way.
So let me see. So she was around for a sec, but maybe she had an internet issue or whatever. So I wonder whether I can pick some of her questions for her. So the question about the oversimplification of the perception of fair taxes. So, and then the question of time effects, and so the question whether time effects in the way that corporations pay their taxes and all this should affect this. I think to some extent, you already showed this to us in your talk, right? You already indicated that it's not that easy to judge whether some tax payment is considered to be fair or not. And
and I like her idea of thinking about loss carry forward. So when we designed the experiment, we thought, okay, what can we do so that you have a firm that is less aggressive? And the two things that come to our mind are credits and losses. We just specifically decided against losses because this could trigger a lot of other things. Then you have a loss firm against a profit firm. And so this triggered a lot of other things. That's why we went away from this loss issue. Yeah. But in the public debate, I mean, that example of Qantas and others, I mean, are out there that people will have to, or firms would have to defend that they don't pay taxes because they made losses in the past. Yeah, so I think I really like this idea of thinking about losses and the perception there. And then when I talked to Victor and Christian about this before today, I mean, Victor just wrote, why don't they run it? And I can just agree on that. Why don't you, I think a study on different kinds of actions that firms take and how they are perceived in terms of fairness, that would be interesting and important, I would say. And it differs across countries, I'm pretty sure.
That's interesting. I like the different across countries idea.
Yeah, across country, different types of methods, like a matrix, and then easy, red, yellow, green. What is okay, what is not okay, and you could see that just around the globe. I think that would be interesting and super helpful also in designing policy.
Cool idea. So somebody do it. Now we have a question, Kathy. I hope you're still around. So you had an additional question about what kind of disclosures would actually be helpful for tax regulators. Are you still there? Sorry for cold calling on you, Kathy.
No worries. I mean, I see the question. I like the question. So
maybe just talk a little bit about it. So the question was related to the question: what is the type of disclosures that a government would need to actually design proper taxes?
So here's the thing. I mean, the question is, what is the objective, right? Again, of the tax system. I think at the moment, if you really think about what information tax authorities already have, they have a lot of information. And what we talk about at the moment is only public tax disclosure. So in the end, how can a public country by country report help the tax authority to change anything? Not at all, right? Because they already have that information. So it can only be a different channel that you force companies into changing their behavior because of public pressure. So actually, countries have already all the information. So that's why I'm always wondering, why do you need that information for tax enforcement purposes? Because there are all these disclosures. And I have a little bit doubts that these information are really used for tax enforcement purposes, or maybe it's more used to create public pressure on firms and taxpayers, which, by the way, can also be fine, right? I'm not negating that, but it's not used for a tax enforcement purpose. That's why you have private tax disclosures. Back then, like Schedule UTP, which, by the way, ultimately, so everyone thought before, oh, this will be a game changer. 6-7 years later, they realized they made it into a boilerplate schedule that didn't change much and didn't create more information. So I think the information is out there. I guess it's rather really about either putting more money in enforcement. So one thing is for sure, enforcement budgets went down in almost all countries around the world. That's one problem. And the other problem is then you could fix the rules a little bit. So I don't think transparency is the answer. Only transparency, let's say it like this.
Perfect. So then we have another question, also originally handed in by Caro, but I will just make it my question. And that's I think a little bit the elephant in the room type of question. So as an investor, should I actually be interested in a firm paying its fair share of taxes? Yeah. So the obvious alternative answer will be no. I would like them to minimize the present value of future tax payments. Yeah? So, what is your take on that one? That's
also, I think, in that cross-country matrix. I think, a very important question. Would you invest in a tax avoiding company? I mean, there are studies out there. I mean, in the end, we know that tax avoidance there's a positive relation of tax avoidance and firm value. So apparently investors appear to be interested in lower taxes, right? Otherwise we wouldn't see that correlation. So in that sense, I thought that this is a super question, and it's also not the first time that we hear that question. For the experiment itself, it doesn't matter for us, yeah, because of the setup, but I think in general, it's a very important question. Maybe in the future, when it comes to CSR, and I mean, certain funds that think about CSR, I think as soon as taxes will be part of CSR, because maybe it's paying taxes is a social responsibility, then maybe you see more inflow in that term. But at the moment, I can definitely see that point.
No, I also think that I was also thinking about it. This is really hard to assess. So for the experimentalists, if you want to get clear evidence on this from a survey or a lab study or whatever, I think it would be really, really hard to get it.
I would say this is beyond my pay grade, and you really need experts in experiments and survey design. I would have no clue how to do it. It is a super important question, I would say. Do we have an answer to that? Maybe some of you know the answer, but I don't, to be honest.
No. And it's like you indicated, it's also clearly related to the whole CSR debate. So really, really important. A future generation of researchers can sort this out, right? Okay, so now we have a question that relates a little bit to financial accounting even. That's the question by Guillermo about the OECD's proposals when it comes to the corporate tax base. Guillermo, you're around, right? So please unmute yourself and ask the question if you want.
Yes, thank you. First of all, thank you for our presentation. It's a great debate. I'm Guilherme Guimarães. I'm from Brazil, from Federal University of Rio de Janeiro. Currently, there was a massive discussion about book tax conformity. It was a great discussion in US, mainly if we will have to conform a book and tax account. And this discussion appeared again with the OECD's proposal in Pillar 2 and the recent agreement with G7 to charge a minimum tax on multinationals based on consolidating statements on IFRS. What do you think about this proposal? Do you think it's the impact, the account information?
So it's extremely relevant question. This debate that the G7 currently have about this global minimum tax, I mean, they apparently have an agreement. However, that looks like, and when it then goes to the next round, I haven't seen that yet, right? So, I mean, I can only make rather general statements. I think at some point they have to agree on a profit number. And of course, they start now with IFRS, but once the US guys are in there, I don't think that they will accept IFRS because they want to have US GAAP. So I think at the end of the day, there will be some kind of mix and we will again have some kind of book tax disconformity. But irrespective of, let's say, we either use IFRS or US GAAP, I think then it really depends on how we actually structure that global minimum tax. What this is about, can it be credited or whatever, right? It's a broader question because ultimately, every multinational has to file tax returns in each and every single country around the world. And there you will not have IFRS or US GAAP as the base for your tax filings. So I think what will happen when this comes is that companies will face a big mess in terms of their internal reporting, right? Because at the moment they have tax reporting, financial reporting. It is of course intertwined, but now on top of that, you then have the global minimum tax if it comes based on US GAAP. I think the compliance cost will be pretty high. That will be my first guess, that compliance cost will be high. Will firms pay more taxes? I guess so. Yeah, this will work out. But the compliance cost will be immense. And the way I understand it, it's really just about the biggest firms that for which they want to use this, right? PMO, I mean, it was really about the very, very largest firms and not the, let's say, broad general public. So it's for the biggest firms out there, let's say it like this. It would be a nice experiment to have book tax conformity. It would not solve the problem, of course, of tax avoidance. You would still have in your unconsolidated statements let's say the intents and the incentive to shift profits. Yeah.
Okay, thank you.
You're welcome.
I have to say that this topic, is I think around as long as IFRS exists almost. I remember that in the early 2000s, we had a little bit of a row within Germany about people that said, why don't we use this new IAS thing for a common tax base in Europe? Wouldn't that be a neat idea? And then all the financial accountants, they were so happy that finally they have some reasonable international accounting regulation. They said, please don't, you will screw up the financial accounting completely. And this is, one of my concerns when it comes to this debate. So think about, even if it's just the global 100 or whatever, if they all of a sudden get an interest in IFRS accounting with a tax perspective, with a tax angle to it, I think the lobbyistic power that these guys have in order to make sure that certain accounting treatments will be changed for more favorable tax consequences can be substantial. So I completely understand why they have this idea. Obviously, you want to avoid that the minimum corporate tax rate is being bombarded by tax base erosion, but at the same time, coming up with a stable system here. So a lot of work for Martin and his friends at the Ministry of Finance, I guess.
There will be a lot of open questions then, yeah. And it's, again, it's this problem that all the companies still have unconsolidated statements for each and every single entity that they have, and that will not be according to IFRS for tax purposes. So that's why it will become interesting. And not only we will have work, Joachim, I think all the tax lawyers and accountants will have a lot of work.
Exciting. But I also have to say this whole debate about the minimum corporate tax rate is something that is really interesting.
Yeah.
And you see, last remark from my side on this, you see the super interesting narrative around this, because this is easy to communicate. Yeah, so this minimum tax rate around the globe, bam, there you go, 1%. Yeah, whereas talking about different depreciation schedules or loan loss allowance or whatever, is a little bit harder to communicate effectively.
One thing, of course, by the way, that you also have to keep in mind when you have this global minimum tax, that certain tax incentives that countries use to foster investment will be out then afterwards, because the global minimum tax will just reap all the potential benefits from these tax incentives, let's say during a crisis when you want to have some fiscal measures, so you can't use them anymore. So it might be that you use now non-tax measures. So the thing is, just because you have a global minimum tax doesn't mean that countries can't lure companies to their country. They will just use non-tax means.
Yeah, this also addresses the question that Carol had about alternative ways on how to foster investment. So Ulrich, I'm not sure whether you want to ask a question about beneficial ownership or not. So please speak up if you want to ask it.
Yeah, if we have time, this is like sort of tangentially related to tax, but I thought it would be interesting to hear from you as a professional. There's this new push to make a beneficial ownership registry, I think, across many countries in the US, in Europe, and I was wondering if this, first of all, I've talked to some local chamber of commerce in Italy, and they were like, yeah, the responsibility is on us. It's going to be very difficult to implement and to make it happen from an accounting point. And I was wondering if you see this as or how you would tackle this as a research topic. How does it lean towards perhaps your tax topic, or if you feel like this is a completely separate research project, where does it fit in? It's my question.
Or if I may ask quickly back, with beneficial owner, do you mean something like a shareholder register?
Well, so what I mean is, when you have I'm not sure. What I mean is that if you have these very complicated structures, like pyramid schemes almost, like for example, in Italy, they're very common. I think internationally, they're very common. Who's the ultimate owner of that shell company?
Yeah. So let's say this way. I think if we would have something like this would not only have research-wise, that would be fantastic, data source. I think we would also solve quite some other problems that are not about corporate tax avoidance, but here we then talk about evasion, right? Here we talk about ways through shell companies going to Panama and Cayman and whatever other countries are out there where there is no information exchange. If we would have a system, of course, of knowing who actually the beneficial owners are, I think we would be a huge step forward in terms of combating tax evasion. Now, the problem with this is it's nice that, let's say, Germany and France and Italy all say, oh, we need that. And then we can pick like 5, 6 countries in the world. I don't want to name one now, but I think we all have some in mind. Maybe there's one country between Germany and Italy that is not that is not Austria, yeah, and where there's bank secrecy. Of course, it would be good to know who's the beneficial owner of a certain secret bank account in terms of fighting tax evasion. I think the problem is that all countries would have to agree on getting rid of this lack of transparency. But for some countries, it is their business model to have no transparency.
I see.
Yeah, but otherwise, I mean, I'm fully with you. I think we would all be better off to know who the beneficial owners of certain structures are. Yeah? In terms of fighting tax evasion, I think there's no gray line there. I think this is relatively clean that there you would need that information just to combat tax evasion.
I see. Yeah. So you're saying it sort of relates to the global corporate minimum tax, where you just need like a standard, or
it might be related to that you really know who operates where, but ultimately this would solve this a little bit. But I think that question about this is where some of the effects that Joachim was talking about, the personal income tax and personal wealth and income inequality comes into play. That of course this evasion in these types of hubs is more geared towards higher incomes. Yeah, so this has a bigger, and it's a different angle that we didn't talk about today, like income inequality and wealth inequality, where this has some implications. I think it's less about corporate tax, it's more about income taxes. Not saying that this is less relevant. I think it might be even more relevant.
Mm-hmm. All right, thank you.
So just one anecdotal remark about this.
But you don't want to talk about your Swiss bank account now, Joachim, right?
Exactly, my large Swiss bank account. No, something that we learned from running surveys with small firms. There is this huge difference, really, it's a huge difference how people react on these type of surveys and questions, depending on whether they feel approached as a person or whether they can see this as a firm. Yeah, so some stuff that Max Müller is also doing is related to firms that actually have it in their name, you know, a human person, right? So, and how this changes their approach to transparency to begin with. I think it would be super exciting to see whether a beneficial ownership registry or something actually has an effect on real entrepreneurial activity. Because some people are, it's a subset of people, but they are so uncomfortable with having their private wealth situation being publicly disclosed that this could really change the way that they operate. So even down to the decision to become an entrepreneur. And I think this is so fascinating for me because this varies so wildly across countries, even within Europe. So think about Scandinavia, people are used to it. So they say, well, what's the issue? Think about Italy, like you mentioned, or Germany. I think this would be entirely different. If talk to somebody from the Handwerkskammer and say, well, why don't we just disclose all the private wealth of every owner of a Handwerk in Germany? I think you would have quite some opposition on this.
Or just the ownership structure. This is like the biggest secret, who owns actually the firm, right? They say you're not supposed to know. And we're just like, yeah, I mean, we're working with Scandinavian data. It's normal there. Yeah. And now you can Google who owns a firm and you find it. Yeah. You even know the income of everyone. Indeed, in Germany, I don't think that something like this would be possible.
Yeah, but even if it would, right? So the benefit cost criteria here. So the benefit is substantial, like you indicated, the cost potentially also. So it's really it's a very dicey policy thing, and I think it would be great to have work on this. Yeah. So no matter how we design it. So now we are moving on to some more meta questions, and So first, I would like to have the question by Guillermo on earnings management and tax avoidance, and then Jeremiah, you can follow up with your, let's say, IT cost related question. Okay, Guillermo. Sorry, I'm
Oh yes, me. Thank you. My second question: do you think the relation between earnings management and tax avoidance still matters in accounting research?
Yeah, it's a simple one. Yes.
Yes, thank you.
And Guillermo, I mean, I think there will be soon an ABR paper on that relation. I know it because this paper will be accepted very soon. I'm the handling editor, so apparently reviewers and editors still find that interesting.
Thank you.
I'm tempted to squeeze in a little bit of a measurement issue thing here. Yeah, so measuring earnings management is hard. Measuring tax avoidance is hard. So if you really want to make progress on that front, you know, if you can do something about the measurement bit, that would be even more exciting. But this is just my 2-cent taste.
Yeah, by the way, the same goes for book tax conformity. Yeah, Guillermo,
yes, the relation.
Knowing exactly the determinants of book tax conformity, understanding it better. I mean, the ideal data set would be someone has a tax return and someone has the financial return and can put it next to each other for a large sample. Yeah? That would be, of course, this would really enhance our knowledge of book tax conformity. And the same goes for this relation, Joachim, that you mentioned. Yeah, absolutely.
Okay, Jeremiah, thanks for waiting.
Sure, yeah. Well, I guess it's sort of a riff on two things. One, there are a number of papers that seem to mention as sort of boilerplate a lot of hand-waving about processing costs for information. But then on the other hand, the experimental study that you ran and mentioned in your talk sort of implies that you have the same interface for providing data that you have for consuming data, right? You're essentially asking the experimentees to look at sort of data as it would be provided by the firm. Now, with increasing levels of IT, with technological change, one might expect that interface can be very distant, and that the processing costs to get from one end of the interface to the other are going down rapidly. And so over the course of this course, we've read papers talking about sort of the equilibrium dynamics of certain information disclosures. And then you wonder, okay, but what happens when we're pushing them along a sort of a technology path, and maybe the equilibrium becomes a less interesting feature. Maybe the technological development and the sort of reduction of information costs is the more interesting sort of object of examination. I'd just be curious to hear your thoughts on that.
When I read about this question, I thought, good that I saw it before, because it's a really good one, but it's tough to answer. Because I think it has, and I now want to use the sender-receiver framework again by Joachim, because I think the receiver, it's still that, of course, you have to prepare that data, right? You have to prepare that information, but still now the question is, what is the receiver doing with it? Yeah. And I think the fear is high that you pre-process a lot of information, and then people will just use that outcome using a heuristic. So either that's a real good outcome that you put out there that people can easily interpret, that it's precise, then I'm fully with you. Of course, the problem is if I don't know what is actually put into this algorithm, how it's processed, and if that might not be exactly the way I think, then I would have to go back, right? So I think it's, I mean, just if you think about what I said like an hour ago on these different tax avoidance methods, which differ maybe across countries how you interpret them, or which even differs within countries how people perceive that. And my fear is that by pre-processing everything, let's say with IT, you people might not actually have that in the way they want it, right? So I think it's still in the end the processing cost will be there. Because it's really individual how you think about tax aggressive or fair. It's super subjective. And I don't think a machine will do that for everyone here. Yeah? So Jeremiah, I think you can program it in the way you want it for yourself. 100% sure, individually you will reduce processing costs for you. Is that some framework that we can use for all 80 here? Probably not.
Thanks.
Yeah, I like that question a lot. And I think it's also related to the question whether we will have specialized intermediaries for these type of problems. So I could think about, for example, an NGO focusing on corporate transparency and tax fairness, lobbying towards having a good API that they can use the data and use this in a, let's say, web kind interface where people can then, on their webpage directly see, how firms actually perform in terms of tax fairness.
And yeah, but Joachim, there is already out there. I mean, there is the Tax Justice Network, for example, but they specifically say that going to Zossen instead of Ludwigsfelde is tax avoidance. And if you personally don't agree with that, then the information from the Tax Justice Network is maybe not useful for you.
Yes.
Then you would need the Tax Justice Network a little bit less fair, whatever, yeah? So you need your own Tax Justice Network that caters how you think about tax avoidance.
Hmm?
Well, as long as they open source the code, you can tweak it.
Absolutely. If they open source the code, that's fine. But at the moment, it's like everything is tax avoidance. And it's like, maybe that's fine for some, yeah, but maybe that's not fine for everybody.
I see the API in front of me with a slider where you can
exactly. Say, ideally, you have like, okay, what do you think is tax avoidance? And you click on it, and then it processes it automatically. Then I'm fully with you. That would be nice. You can decide what you think is aggressive, and then you click on it, and you get the output.
Perfect. Okay, so now we not only identified, let's say, one or two exciting new research topics that we can tackle. We also started up with an idea for a web page that can beat the hell out of the Tax Justice Network. So let's see how this all translates into real action at some point. But first of all, thanks a lot, Martin, for doing this. I think there was a very lively discussion. Thank you to all of you who sent in questions and you participated in the discussion. I think that was really worth our time. As I said, in 2 weeks, we're going to visit another hot topic, and that's non-financial reporting, CSR reporting with Gio Mikolon. She's an absolute expert in that area as well, and also a great presenter. So I think we also will have a nice last session in 2 weeks. Until then, enjoy, pay your taxes. Sorry, just kidding. And thanks for sticking around. And Martin, thanks again for doing this. Great. Cheers. Bye.